Now let's start with the first and overarching theme of the year. In general, on an annual average basis, we expect metal prices to average slightly higher in 2024 compared to 2023 levels, but remain under significant pressure. We hold a mildly positive view on the overall metals complex in 2024, as you can see from this table, which presents most of our proprietary metal and mineral ore price forecasts. Most of the commodities here will average slightly higher in 2024 compared to 2023 on an annual average basis, but there will be no return to 2022 highs. Our prognosis is based on a confluence of factors, including fundamentals, technicals, and the global macroeconomic backdrop. In general, this year, we do not expect prices to see the steep declines of 2023. There are a number of factors placing a floor under metal prices, but also other factors building a strong resistance to cap price growth. Now, this essentially means we expect more price stability this year, ceteris paribus. Those two words, ceteris paribus, if all else remains equal, are the most important words any analyst can use these days. Barring any external shocks to the market that we cannot envisage right now, global metal prices are on a more stable pathway in 2024 than the last couple of years, as is evident on the left-hand side chart here, where you can see the most commonly used industrial metals indices as volatile as ever since 2020. On the right-hand chart here, you can see select metal stocks, inventories on the LME to be specific, and over the course of 2023, you will notice a substantial buildup due to a number of factors last year, including but not limited to weak demand and oversupply. With stocks at a higher level in 2024 compared to the past few years, downside risks to prices remain high, with the sector significantly exposed to poor sentiment or weaker demand than is priced in at the moment. Despite our outlook for greater price stability, we highlight that metal prices are prone to downturns should negative external factors aggravate the market. Looking within the metals complex, we expect ferrous metals to benefit more in 2024 compared to base metals. Among base metals, we expect copper to fare better than aluminium and nickel due to the copper market being tighter than the latter two in 2024. Among ferrous metals, we expect iron ore to lead gains in the overall industrial metals complex as price resilience continues from positive sentiment over mainland Chinese stimulus hopes, falling port inventories, and strong demand from the country's non-property sectors, including machinery, shipping, autos, and infrastructure. Now, at this juncture, it's imperative that we speak about mainland China and what is happening in that market. China is the world's largest producer as well as consumer of metals, as you can see on the left-hand chart. So policies in China, news out of China, and of course fundamental demand and supply in China impacts metal prices greatly. China has always been and continues to be a major risk generator for metal markets globally. The mainland Chinese economy continues to face a number of downside risks. Most importantly, to metals is its real estate sector's financial difficulties. Our country risk team forecasts Chinese economic expansion will slow to 4.7% in 2024, with risks slated to the downside. Excluding 2020, this would be the country's slowest rate of growth since 1990. PMI figures, as displayed on the right-hand chart, remain grim, offering little hope for a strong rebound. As well, we believe the housing market downturn in mainland China will last years, weighing on metals demand. After years of serving speculative demand, the housing market is arguably oversupplied, especially as the downturn has likely led to the exit of speculators. Meanwhile, still poor affordability and weak sentiment means that serious home buyers are likely to stay away as well, especially as more developers are likely to face financial difficulty. So all this just means that metals demand from mainland China's property sector is not going to recover anytime soon, and definitely not in 2024. Now, that said, we believe the government will stick to its commitment to support growth. This was reiterated during the most recent Central Economic Work Conference in December, during which policymakers signaled a 5% growth target for this year, 2024. And stimulus should ensure that infrastructure spending will help to offset weakness in real estate investment. We also expect other sectors, including machinery, shipping, and autos, to prevent a collapse to metals demand. Now, moving on quickly to gold, precious metals in general, we hold a very optimistic view on gold prices this year, as the safe haven asset, as you can see on the left-hand chart, is boosted by a number of factors, including the fall in interest rates and expected rate cuts by the US Fed. Gold has benefited from economic and geopolitical risks since 2020, with prices witnessing a pronounced rally since the start of the war in Gaza in October last year, and amplified by the US Fed's dovish tone at its December meeting and the weakening of the US dollar. On the right-hand side table, you can see most of the gold price drivers that we have listed here indicate a bullish outlook for gold in 2024. Now, moving on, for both industrial and precious metals, price direction over 2024 will be determined much by the macroeconomic outlook. We expect the global economy and most developed markets to continue slowing in 2024, severely impacting demand for metals. That said, our outlook towards the global economy is now less bleak than it was a few months ago. Our country risk team is now forecasting a much gentler growth slowdown in the US, from an estimated 2.5% in 2023 to 1.4% this year, compared with 0.8% forecasted previously. And this supports our view of a slight increase in metals prices, but not a rebound. Looking at the US dollar index, the DXY, weakened to 101 at the end of 2023 as the Fed made it clear that they were done with the hiking cycle and the next move would definitely likely be a cut. It is now hovering around 102, which is significantly lower than the 2022 high of 114 and 2023 high of 106. Our macro team expects the dollar to trade within a range of 100 to 108 this year, with potential for the DXY to push even lower to the 95 level should the Fed turn even more dovish as inflation cools, or if there is a continued pickup in risk sentiment. Now, this will support demand for metals, general commodities that are priced in the greenback. Overall, we believe 2024 will be a close tug-of-war between fundamentals and sentiment driven by macro factors. As you can see on the left-hand chart, we expect most metal markets to tighten in 2024, forming the basis of our more positive price outlook. Notably, we expect the copper market to head in deficit once again in 2024, driven by demand from the power and construction sectors globally. While the outlook for these sectors are positive in 2024, the other two major metals demand generators will see a slowdown. These include global vehicle production and household spending, preventing demand and prices from rising significantly. So to finish up, we expect 2024 to tell a demand-side story as metals across the complex await for stimulus from mainland China, one that would actually materialize, and a pickup in demand from all kinds of global industries to see the light at the end of the tunnel.